Howdy everybody, Professor Martin here with more managerial accounting. In our video right now, we're going to be talking about cost of goods sold. Now you might think, well, cost of goods sold, I know what that is. Anytime we sell a product, it's cost of goods sold, and the book gives us that number and everything is great. Yeah, well, we need to talk a little bit more about it because you're living in accounting utopia. Accounting Utopia is a beautiful place. It's an island where the weather is never bad. It's 80 degrees and sunny year round. You have a hammock right in front of crystal blue water, and a server will bring you whatever food and drink you want, and you're just living in paradise in Accounting Utopia. And the book will tell you sold a product for $500 in cash. Cost of goods sold was $200. In Accounting Utopia, the food and drink is brought to you and the numbers are given to you. You don't even have to think about it. That's Accounting Utopia. That's where you've been living probably. I'm going to bring you to accounting reality. This is accounting reality right here. In accounting reality, we have to figure cost of goods sold. We have to know how to calculate it most of the time. And that's the real world, okay? So we're taking off the training wheels here a little bit and making you calculate cost of goods sold. The good news is, it's not that hard. We'll take one step back, cost of goods sold. The cost of goods that were sold during the period, just like it sounds like. Sometimes you'll see a statement, an income statement where it's called cost of sales instead of cost of goods sold. Exact same thing. As a matter of fact, if we look at Nike's income statement, we see right there, cost of sales or cost of goods sold. Means the exact same thing. You think, well, what's the big deal? Why is it so hard to come by that number? Or why do we have to calculate? Well, the complication comes from the reality that a manufacturer is going to start and end every period with finished goods inventory. They don't start with no finished goods inventory and then just sell everything that they make. If they did that, it would be very simple. If we started with no inventory and finished goods, and we sold every single item we made, cost of goods sold would just be the product cost. Nothing really to think about there. But because our manufacturers will begin a period with finished goods inventory and they'll end the period with finished goods inventory, we got to figure out how much inventory was sold. So that's our complication. Calculating cost of goods sold. I mentioned it was a pretty easy process. I'm going to show you the calculation right here. We begin with cost of goods manufactured during the period. Sometimes that number is going to be given to you. Sometimes you have to figure it out. We had a separate video where I walked you through how to calculate cost of goods manufactured. In your homework, you'll probably do a cost of goods manufactured schedule where you get that number at the end. So we'll begin with that. We're going to add in our beginning finished goods inventory. Now, if you think about that for a second, what we completed during the period plus what we began with. That's the total amount of inventory that we have available for sale. We can either look at it from a dollar standpoint or from a unit standpoint. All right? What we finished during the period and made plus what we began with. You add it together, that's the total amount that we have. We're going to subtract out what we ended with in inventory. So the total amount of what we had minus what we have left over, the difference has to be cost of goods sold. It's not here anymore. It must have sold. Cost of goods sold. Pretty simple, right? Write that formula down, jot it in your notes, and we'll practice it a little bit in our homework. Not a terribly complicated calculation, thankfully. Go ahead and work an example here. We got Bingo Denim again making blue jeans. In the month of June, they completed 100,000 pairs of jeans. Cost of goods manufactured is $546,000. Again, you usually have to calculate that number. I'm just throwing it out there for you. Assume that on June 1, Bingo had 25,000 units in finished goods inventory that they had a cost of $130,000 in. Then at the end of the month, June 30, Bingo had 50,000 units in finished goods inventory, costing $247,000. Now later on we'll do problems where it specifies that the company is shooting for a target as far as ending inventory. Maybe they want to end up with 10% of the projected sales the following month. And we'll get into that later on. For now, just roll with the numbers that were given. We'll pull up our handy dandy calculation here. Cost of goods manufactured during the period was given $546,000. We're going to add in the cost of our beginning inventory, $130,000. We're going to subtract out what was left over, $247,000 worth of inventory left over. The difference has to be cost of goods sold. Easy as that. I mentioned we're looking at it in dollar amounts. We can also look at it in terms of units. How many units of inventory? Just tweak our terminology a little bit. The number of goods we finished during the period, plus the number we had on hand at the beginning of the period, minus the number we had left over in ending inventory at the end of the period, gives us our units sold. Using the numbers from our example, 100,000 units that we completed during the period, plus 25,000 from beginning inventory, minus 50 left over, we sold 75,000 units. And so cost of goods sold, it's not something that's just going to be handed to you on a silver accounting platter. Sometimes you gotta have to do a little work in order to get the numbers we need. And that's an example right there. Summary of cost flows. Put all this stuff together that we've talked about with cost of goods manufactured, cost of goods sold, direct material, labor, and overhead and all that. How does it flow through our accounting system? Well, we begin with direct material. We buy direct material, and let's say that we got a production order and we put that direct material into production. Well, it's going into inventory at that point. We put in 256,000 into production. You can see we bought 210,000, added it to our inventory, and then we put some into production. 256,000 of direct material going into production. It gets dumped into work in process. And we're going to carry the direct material cost, the direct labor cost, and the overhead cost in work in process inventory. Until what time? Until the product's done, right? And then after the product's done and we're finished with it, it's going to go from work in process to finished goods inventory. And we see here the example. We added direct material, labor, and overhead together. The product's finished at that point. 575,000 cost of goods manufactured gets transferred to finished goods inventory. And it sits on our balance sheet in finished goods inventory until it sells, at which point it gets moved to the income statement as cost of goods sold. All right. So that's the process right there. If we're talking about a manufacturer always has 3 different kinds of inventory. They've got raw materials inventory. You see that right there, raw material inventory. They got work in process inventory, things they've started but haven't finished by the end of the period. And then they've got finished goods inventory, things that they're done with, sitting on the shelf, ready to be sold, sitting in the warehouse, ready to be sold, whatever the case might be. So if you look at a manufacturer, if you pull up the financial statements for Ford, General Motors, John Deere, Caterpillar, Procter & Gamble, whoever you want to think of that manufactures a product. Normally, if you look at the balance sheet, you'll just see one line that says inventory. But if you dig in those notes to the financial statement, you'll see that breakdown of material, work in process, and finished goods inventory. The takeaway, cost of goods manufactured and cost of goods sold. Usually the public never sees that calculation, but those calculations are crucial to the income statement for a manufacturer. As you can imagine, cost of goods sold, we've talked about being the biggest expense most of the time for a manufacturer and a retailer. All right, so a very important number. We need to know how to calculate it. Hopefully that will get you squared away on making your cost of goods sold calculation in any of your homework problems that you're working that require that information. If you have any questions or need any help on your homework, please feel free to reach out. That'll do it for this chapter. We'll move ahead and learn more managerial accounting next time. Until then, take care, everybody.